Welcome back. Now it's time for top picks. Paul, let's start with Bank of America. Why do you like this stock?
Yeah, so Bank of America is one of the largest banks in the United States. It has about 10% of all the deposits in the United States, which by definition means that they can never buy another company. They really have to grow organically. That's one thing. The other thing is that I think that they continue to reduce costs and headcount, and mostly by using technology, which I think is very important for banks to do that. I think they have a great capital base. Their Tier 1 capital is at 12%. They trade at 1.2 times book, and it yields about 2.4%. So I think one of the issues that are facing with interest rates going up, you have, because they have a large retail franchise, net interest margin continues to go higher for them, which is very good. It's kind of offset though because when you look at the investment bank, et cetera, they're having a more difficult time on the investment banking side. There's no IPOs, very little M&A going on, et cetera. So that's been offset. But I think the company in the right environment next year will probably do very well in all the different sectors of their business. So to me, that means that you want to buy it here at a reasonable price to book level. You're getting, like a lot of Canadian banks as well, they can buy back shares, they can increase dividends, they've got a lot of excess capital, and because they feel there's a slowdown, they'll again over-reserve, which is good because they can bring those reserves back into the earnings in the following year. I think the stock is worth well over $50, and I think that if you buy it here, you'll do very well, especially when all these other parts of the business start to execute, because the world is changing, sort of thing. So you get back more M&A, you get back more IPOs, so the investment banking side will do well, and then the retail side will also continue to do well. So I think they've got some great businesses. They've executed very well. Brian Monahan, who runs the company, has always been given, he's not as well credited as Jamie Dimon, but he's done a fantastic job there.
Okay, and what do you make of the prospect of mortgage upheaval and what that means in terms of paper losses for this bank and its peers in this space, in this higher interest rate environment that could be coming?
Yeah, so I think that the mortgage industry is very different in the United States because it's securitized, right? It's not like the Canadian industry here. So they securitize most of their mortgages off their books. I think they're much more cautious given what happened in 2008, 2009, and they tend to, I think, if they feel that they're going to have more problems, they would over-reserve in a way that I think and they have the ability to do that. All they have to do is stop their buybacks, they stop their dividend increases. So I think they're in good shape that way. They don't have to worry about it as much, and they're not doing as many esoteric mortgages as you saw years and years ago.
Right, great. Okay, next is FirstService, TSX listed. What do you like about this company?
So it's a residential property management company, and they do a services business like California Closets, Paul Davis. There's a bunch of different ones that they do. I think there's really room to grow because the market share in the U.S., they're one of the largest players in the U.S., but the market remains very fragmented. So they've grown in two ways: one by organically, and the other one by making, good tuck-on acquisitions over the years. I think it trades around 27 times earnings. It's always had a high multiple. It doesn't pay a very strong dividend, but it's not a very capital intensive business, and it has a fair bit of free cash flow that it throws off. The other thing that's important about this business, especially on the residential property side, they tend to sign contracts for a period of time, and there's inflation protection in those contracts, right? So I think that really helps them in this environment. It's a big play on the U.S. side. It grows in Canada as well, but it's really a unique Canadian company that is done very, very well over a long period of time.
Are there any sectors of the U.S. market in particular in terms of their residential property management that you see them taking advantage of in the next year or so?
Well, I don't think they can really. They have a very specific way they think about their business. They buy kind of, they do a lot of work on gated communities and things like that, or condos and stuff like that. So they don't really. They tend to be more service orientated in that way, and they use these other things like California Closets to help them with when they're dealing in those communities. But they're not going to be able to. They don't buy buildings as such. They tend to be more service inside a building, sort of thing.
Okay, next we have Visa, bullish take in terms of Bloomberg consensus ratings, 36 buys, 3 holds, and 0 sells. What do you like about the business?
Well, so Visa is like a toll booth, right? They basically make, 15 basis points for every transaction that takes place. There's still $17 trillion in consumer transactions that are still in cash. So there's great organic growth. I think on the business-to-business side, they're not as big as as people think, and so there's a lot of opportunity on the business-to-business thing, especially with loyalty programs, et cetera. So I think that's one of the things. So I think there's some good growth internationally for them. I think that they're improving. I think an improving macro backdrop will help them. I think there's faster anticipated growth from consumer payments on innovations on mobile payments. So more and more people are happy to use credit cards or some kind of mobile access as opposed to using cash nowadays, especially because of COVID, right? So I think that will continue to happen. I mean, they're going to generate about $18 billion of free cash flow in 2023. It's a really great business. It really throws up a lot of free cash. I think it's hard for anybody else to compete with their network. And it's such a powerful, they do 64 transactions a second. I mean, it's a very powerful brand that they've built. And I think that they have a lot of opportunity to grow still organically.
Okay.
And acquisitions are a little bit harder, I think. So
okay.
Organically, they can grow a lot.